Good morning, good afternoon. So, welcome, guys. So, from the previous video, one before this, about 2 months ago, and we've had choppy price action because of length. So, we just finished length, that is the Passover. We just finished Passover last 2 weeks or so. So, that is why we're having that's why the market is now allowed to trade because there's been a lot of big money sitting on the sidelines before doing the Passover and directly after the Passover week. So from the previous video, we indicated this relative equal lows, which was swept here. This has sell stops resting here below here. So So we had sell side liquidity here, which was swept here. And this, when price traded down below this side here, smart money was buying all of these candles, all of these down close candles, these black candles. So because smart money was buying, so when it rallied higher, when we had this rally higher, it was confirmed that this is the bullish order block here, which is this. I'm just reiterating from the previous video before we get into the vast stacks of what we have to talk about today. So we noted this bullish order block here, like about 2 months ago, and this year buy side liquidity, which is resting here. So this buy side liquidity, which was resting here. So we indicated from the previous video that the dollar is bullish because of the order flow from the higher time frame. The higher time frame order flow for the dollar is bullish. So when every job is seen as a form of manipulation to fueling smart money entry. So when price was dropping down here, when price was dropping here, we expected price was expected to drop down to an optimal level, which should be below discount. Here it will be seen as an optimal trade entry, but that's not what this discussion is about. So maybe on another lesson we'll talk about the optimal trade entry and why it's relevant. So from this low to this high, when this high has been established, here you project the range. So we projected the range from this to this, and when price was dropping lower, we're expecting price to come to a discount level because you buy at a discount and sell at a premium. So price dropped to the other block, the fair value gap, which is inside of an order block, which makes this a high probability order block. So we had a drop inside of the order block here. This order block here is why we're bearish. Sorry, why we're bullish going into April and May of this year. So because seasonal tendency, it's typically bullish within the middle of April through May, which will signify which will cue in lower prices for the indices and the currencies. So we did that here. We traded back down inside of this order block. So this is a factor in price. So we traded back inside of this bullish order block here, which is a discount, which is at a discount from this low, from this low, which is at a discount. This other block here and this other block here, it is at a discount within this price range from this low to this high. So that's what we talked about last week, last on the last video. So we had price coming down inside of this fair value gap, and we had a rally for this past week going higher. So we'll be seeing higher prices. We should be seeing higher prices in the higher time frame. We should expect a drop in price, a manipulation drop in price a little bit at this mitigation block. Yeah. So they will add to their position. Smart money will add to their position here. They'll take out their losses here and reverse their position, take out this buy side liquidity and trade inside of this CB here, which is resting here. But this CB is lacking in buy side, in sufficient buy side delivery. We only had this year which traded inside of the first quarter of this CB. So that's it. So going forward, for the euro, we've been bearish because price traded to this buy side liquidity here resting above this place. So when we add the value up to this, take out these highs, and these highs here. When price valued up here, we had a quick drop in price, leaving this imbalance here, leaving this imbalance here. So this now is seen as a long-term high. When price rallies higher, we will see that as a suspect rally, which will become an intermediate-term high, which is trying to rebalance any imbalance that's created at this job lower. So and we're working with this bearish order block here from the previous video. And as you can see, we traded into the bearish order block and inside of this fair value gap here, and we broke lower here again and traded back again inside of this other block here, and we dropped lower targeting these lows here, which is resting. So this here we have sell side liquidity resting below this low. So we have sell side resting below this low. So there is likely probability for price to come below this, below the discount point of this. You mark out the premium arrays which we already did here. So we'll move from a premium PD array here to a discount PD array, which is this. This is the most obvious PD array here we have from this time frame. So this is the most obvious fair value gap here, which is our ultimate drawn liquidity after price gets to this sell side liquidity here. So let's continue with the dollar. Let's get right to it. Starting with the dollar. So this topic of conversation will be on market structure. So what is market structure like? Actual market structure, not as the rest of the trading community regards market structure as higher low and higher highs, like actual market structures in algorithmic perspective. So what the algorithm does, so let's say this here is the long-term high.
This here is long-term high, and this here is the intermediate term high. Why is this an intermediate term high? So when price goes higher, from the previous videos on other block, I touched a little bit on market structure. So as you can see from this point to this point, the market has been obviously bullish. So every time every time it rallies higher, it retraces back down to filling an imbalance or trade back into an order block to go higher. So it keeps doing this continuously. So when you're watching price, you watch for a break of market structure. You wait for price to break. So this is a break. This is a break of market structure. This bullish order block here failed to hold. So when an order block fails to hold, it signifies a change um, from a buy program to a sell program. So this right here, this break of market structure here initiates this into a sell program. But this is not an energetic move lower. So it's going up and down. So without leaving any much of an imbalance, apart from this imbalance here. So you might likely not see this as a break of market structure. So you have to wait. You wait for an energetic move lower, which will be clearly defined as a break of market structure. So we got that here. We got that here with this imbalance being created here. So we got that with this fair value gap here, which is the low of this candle and the high of this candles. You see, price leaves an imbalance here and also an imbalance here. So in your mind's eye, you leave for allowance for price to come inside of this fair value gap here. So you create an allowance for price to trade inside of this fair value gap here, but not above this other block. This right here, this set of up close candles, these two up close candles is the bullish order block. So you're not expecting price. So you're because of this candle, because of the length of this wick of this tail here, when an order block has a relatively long wick, you use the low of the order block, the midpoint of the wick, and the opening price of the other block. So let's mark that out, which is this the opening price and the midpoint. That is where you want to anchor the price. That is the last PDRA you want price to hold. So price shouldn't trade above this PDRA because this is the last up close candle for the move lower. So when price was swelling higher, smart money that are in the know that are seeing this as a break of market structure will be expecting this any rally that is going up should not take this long term high because this was the high created before this change in state of delivery, before this break of market structure. I mean, so when this intermediate high is created, you you expect price to break this low, which will be an obvious break in market structure. This will be a break of structure, changing the state of the delivery from a buy program into a sell program. So when you have a buy program into a sell program, you expect price to trade to at least the midpoint of the range which has been recently created. And the range that has been created here is this low to this high. So you expect price to drop to the to move from the premium level to the discount level. So your first target here should be your first view on liquidity should be at least the midpoint of the range which we're trading inside of. Then you start looking for PDRAs for discount PDRAs. Here we have this bullish order block here as a discount array. We have this bullish order block as a discount array. We also have this relative equal lows, which are resting below this, which are resting above the bullish order block. This is relative equal lows. So these are relative equal lows. So you have the buyers from here. They would they would have adjusted their stop loss to this low. Yeah, why price value is higher. So at a future time in price, we expect price to come back to that form of liquidity to take out the sell stops here, which are resting orders, which are orders that are already resting below the market price at a discounted price. So back to this market structure. So when an intermediate term high is created and it is and the swing lows like this is broken, every rally higher, every rally after that should be seen as a suspect rally. Every time price rallies up, you should see that as a subset as a suspect rally, trying to balance an imbalance. So that is what price does. As you can see, another reason this is an intermediate term high. There's a little there's a form of liquidity, there's a form of imbalance here when price took out this break of this low, when price broke out that low. So this is the imbalance here, which was which is resting here. So this is an imbalance here. So every time price rallies up to balance an imbalance, that is an intermediate term high. And when price rallies to another to fill out the imbalance that is created after an intermediate term high has been created, that rally should be seen as suspect rally to go and fill the imbalance that was created, possibly the other block, which is this. So you make use of the low of the other block and the opening price of the other block here. So let's look at another example, something we did of recent. Yes. So from this recent price action, as you can see, when price took out this previous monthly highs,
So this was the previous monthly high. This this is the previous monthly low. So going into the second week of April, we expected price to trade below this this year, this fair value gap, which was created on the week of March 18th. When you have a close, when you have a week like this without the body closing inside of the fair value gap, yeah, in a higher time frame, uh, in a higher time frame, you expect the next candle to trade below it and come back up to use this. You expect the next candle to use this BC here as an inversion BC, as an inversion fair value gap, take price lower to this other block, to this set of other block, and possibly lower. For the next, for April to May, we are expecting lower prices. April to May, we're expecting lower prices for the indices. So let's go to the lower time frame. So as you can see, price does that here, traded up, creating this low here, which broke out here. So when this low was broken, it is seen as a market structure shift, which every rally out after this low was broken is seen as a suspect rally. This is a suspect rally. This also is a suspect rally. Trading inside, trading to this other block, trading to this other block. Yeah. So that's the market structure lecture. So when price valued above this previous monthly high, it was seen when price valued above this previous monthly high, we had a sharp drop lower, dropping below this low and this lows. This is seen as a market structure shift. Market structure, it has shifted from a buy program into a sell program. Yes. This is seen as a break of structure, break of structure, because we've, we've had higher prices here. And this when this low was created, this is a long-term low, and this is an intermediate term low. Then price valued higher. So when this low was broken, this became the long-term low, the long-term high. So this became the long-term high, and every rally after the long-term high has been established, every rally is seen as a rally to balance and imbalance. So every time price goes up to balance an imbalance, that is seen as a to rebalance an imbalance that is seen as an intermediate term high. So this so price valued up to balance this imbalance here, which makes this an intermediate term high, which makes this an intermediate term high. And another characteristics of intermediate term highs is that they have short term highs at their sides, which is this high here and this high here. But when you're trading, when a joint liquidity has been established on a higher time frame, so you can see these lows, they are relative equal. They are relative equal. So this is joint liquidity. Liquidity equals. So when this low was broken here, it's anticipated that price should come to draw at least to the midpoint of this range or of the range between this low and this high, which when you project your Fibonacci on it, this is the low. This is the equilibrium price point of it. So every PDRA below this 50% of this range is a discounted price, is a discount PDRA, and every PDRA above of it is a premium PDRA. So you mark out the discount PDRAs from the range, which is this fair value gap. And this right here is a premium fair value gap. So we traded from the premium fair value gap to the discount fair value gap. But because we have not reached our objective, which is the joint liquidity, yeah, every rally going higher, we see that as a suspect value. So we don't expect that value to pierce above this bearish order block, which is this last up close candle before the injected move lower. So every time price value is higher, we see that as a suspect value, which is going up to rebalance the imbalance that has been recently created, which is this. So all of this value here is seen as a suspect value going up to balance this imbalance here. Because currently now we see this as a breakout. We see this as a breakout. So the breakout traders, they'll put their stops here below these lows, below these lows. So they will have their sell stops resting below these lows. And smart money wants that. So their lows here will be used as counterparty for the sellers here for smart money sales, which will sell from this bearish order block here to offload their position here. So when they sell here, the positions will be offloaded here, which is the market efficiency paradigm, pairing sell orders with resting buy orders. Because that's it. So for the next few weeks, I'll be posting market reviews and market forecast, weekly forecast every week. So I'll look for a date. I will announce the date sometime in the future in the group. So we'll be doing weekly forecast to stay on point and stay in line with the group because it's been a long time coming since I last made a video like this. So I hope you got something from this. I'll see you guys next week. And good luck, good trading.